With just over a week left in 2022, I want to share with you my dividend investing strategy for this upcoming year, and in doing so, we'll be talking in depth about the current state of my portfolio, both the good and the bad, as well as how I plan to approach 2023 from an investing standpoint. But first, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. And with that, I want to hear from you. Leave me a comment below and let me know, what are some of your investing resolutions for 2023? What are some goals and things that you'd like to accomplish in your portfolio in this upcoming year? I'd love to hear about it. Now, getting into my portfolio, 2022 was a really good year for me, guys. Throughout the year, I only lost about 1.4%, which on the surface doesn't seem that great, but this is a pretty decent rate of return considering how the rest of the market performed. Just comparing my dividend portfolio to the three major indices, the S&P, the Dow Jones, and the NASDAQ, you can see that my portfolio generated a higher rate of return than all three major indices. In 2022, the S&P dropped about 18.6%, the Dow Jones about 8%, and the NASDAQ about 31.5%, all of which are much greater losses than what my portfolio saw for the year, so I'm definitely thankful for that, and this is actually the second year in a row that I've beat the market. Just a quick recap of 2021, my portfolio grew by 31.6%, which beat the S&P by about 3 percentage points, it beat the Dow Jones, and the NASDAQ also by about 10 points, so that's pretty solid. And at least this year, I think my portfolio's outperformance came as a result of two different factors. I mean, number one, my dividend income most definitely saved me this year. Throughout 2022, I saw unrealized losses of about $2,200, which means that my stocks dipped in share price by, in total $2,200. And like I said, my dividend income totally saved me this year. I brought in just over $1,700, which results in a net loss of about $475. But dividends aside, guys, I think inherently my portfolio is just set up to be more defensive. And with that, many of the stocks that I'm holding saw less share price losses than the three major indices we just looked at. And taking a look at the year-to-date performance of all of the stocks in my portfolio using Seeking Alpha, which by the way, guys, Seeking Alpha is currently running the deal of a lifetime. They have a flash sale going for the end of the year where you can get 1 year of Seeking Alpha Premium, which you guys know I swear by Seeking Alpha. It's my favorite stock research platform, but you can get 1 year of premium for only $39, which is 83% off the normal price of $239. So by taking advantage of this very temporary and also very generous deal, you're able to save $200 on what I think, like I said, is the best stock research platform out there. So if you guys want to learn more about this deal and sign up, there is a link to it in the description of this video. I highly recommend you guys check it out, and if you have any questions, you can certainly ask me in the comments. I'm happy to help. But anyway, taking a look at how my stocks perform year to date, you guys can see that I have a few that are actually in the green where the entire market has been in the red by quite a bit. There are a few stocks in my portfolio that actually saw positive performance, like Chevron, which is up 45%, which is unreal. AT&T, which is surprisingly one of my best performers right now, up 27.3% year to date. AbbVie's up 20%. EPD, Coca-Cola, Snap-on, Johnson & Johnson, and Southern Company also all saw positive share price returns in 2022. And then there's some others, if we keep scrolling down, that still outperform the market even though they were in the red. Altria Group, WP Carey, Procter & Gamble, even Realty Income. And then scrolling down, there were some losers, guys, that did worse than the market as a whole, like Intel, which was down 48% for the year, no surprise there. KRC, which is down 42.3%, 3M down quite a bit, Verizon down a lot, Lowe's down 20%, Main Street, same thing. But as you guys know, we dividend investors can take these share price losses and turn it into a big win by averaging down and picking up more shares as the stock's prices get lower and lower. And that's exactly what I did in 2022. And in fact, some of the biggest losers in my portfolio were also the stocks that I bought the most shares of and invested the most money into, like KRC here. Throughout 2022, I invested about $1,600 into KRC and also did the same thing for Procter & Gamble, put in about $1,600 there. And Snap-on, which is actually not one of my biggest losers, it's actually up for the year, was my third biggest purchase in 2022. I invested nearly $1,900 into that. But my top two biggest purchases were from some of my biggest losers, Starbucks and Lowe's. With Starbucks, I invested nearly $2,000 into that, making it my biggest position. And Lowe's was a stock that I bought the most of this year. I invested nearly $2,400 into that. And for the most part, all of these big purchases were in alignment with my investing strategy going into this year. Coming into 2022, I wanted to emphasize higher growth dividend stocks as opposed to those that have higher yields. And my top three biggest purchases most definitely check that box. These were all lower yielding stocks with respectably high dividend growth rates, like Snap-on, whose 5-year growth CAGR is about 14.8%, Starbucks, whose 5-year CAGR is 13.75%, and Lowe's, whose 5-year dividend growth CAGR is sitting right up there near 20%. All three of these are pretty good companies in my opinion, so I'm really happy to have dumped a lot of money into them this year, and they also helped me reach some really cool milestones in my portfolio. The first milestone was crossing a $40,000 market value in my main portfolio on Charles Schwab, which is nearly $10,000 more than where I was was at this time last year. The second milestone, if we take a look at the dividend log page here, was crossing $200 of dividend income in a single month. This was a really cool milestone that I actually hit last month in November, very recently. And the third milestone, if we take a look at both of my portfolios, which include my main one on Charles Schwab and my Roth IRA on M1 Finance, this third milestone is reaching over $2,000 of annual dividend income. Which, by the way, guys, this is something new we're looking at here. I've been working on version 6.0 of the spreadsheet, which I hope to release in the coming months or even weeks. But just as a little teaser, it's going to include support for multiple portfolios, because I know a lot of you guys have been asking me about this, and I know a lot of you out there have more than one portfolio. So with this, you'll be able to track up to 2 different portfolios at this time. And with that, guys, there are some areas that I feel that I fell short in my portfolio in 2022, with the biggest one being not maxing out my Roth IRA, which is something that you guys have been writing me about all year, and I understand it. And I know I still have until April of 2023 to max out for 2022, but realistically, all I can afford to contribute to my Roth right now is the same $50 per week that I've been doing. But overall, I feel really good about this year. I think I made some pretty good decisions in my portfolio, which I think can be seen from its overall performance. And I'm also very proud of the progress that I've made and continue to make as an investor. You guys know this is a constant learning experience, but I've noticed an evolution in my investing skill set throughout the year, which I guess is bound to happen the longer you do anything, and I look forward to getting even better in 2023 and beyond. Having said that, regarding my strategy for 2023, I don't see it changing all too much. I still plan to prioritize buying stocks like Snap-on, Starbucks, and Lowe's that offer those high dividend growth CAGRs. But at the same time, that's not to say that I'm necessarily going to shy away from the higher yielding stocks in my portfolio like the KRCs, the ORCCs, and JEPIs that I've also been adding to throughout the year. Truth be told, my mindset towards high yield dividend stocks is starting to change a little bit, which I plan to make a full in-depth video on at some point in the near future, but I think differences in yield and having stocks that offer different cash flow returns is another way that you can diversify within your portfolio. And in this regard, I like to maintain a healthy balance, which is why I have both. I have those higher yielding dividend stocks that offer high cash flow returns today, and I have the opposite, lower yielding stocks whose cash flow returns will grow exponentially faster as time goes on. I guess all of this is to say, at least for now, that dividend yield alone is not indicative of a good or a bad investment, which above all is my main priority, right? Like investing in stocks that I think are the good ones. And with that, I could definitely see myself adding a few more positions to my portfolio in 2023. And just to give you a behind the scenes look, there are a few stocks in particular that I'm getting really excited about. The first of which is Rollins, which is a stock you may have heard me talk about before, but this is one of the global leaders in pest control, and their financials are looking really strong, and their dividend stats aren't too shabby either, with a 16% 5-year growth CAGR. Another one that I've been diving into lately is Intuit, which is a software company that owns widely used products like QuickBooks, TurboTax, and MailChimp. And once again, the financials on this stock look really strong, and they also have a very impressive 5-year dividend growth CAGR of nearly 15%. The big question with these two right now is the valuation. They both have really high PE ratios that are much greater than those of the stocks I usually gravitate towards, but maybe it's justified considering the growth that both of these businesses are seeing. I don't know, guys. I still need to spend some more time with them. And I also have my eye on 2 other stocks that I've been wanting to add to my portfolio for some time now. The first one is Apple, and I actually got a price alert from Seeking Alpha this morning that it finally hit $130 per share, which once again, guys, $39 for Seeking Alpha Premium, the deal of a lifetime. But back to Apple, it looks like it has creeped up a little bit and is now pulling away from that $130 price point. But if it does get down into the 120s, I will highly consider pulling the trigger and adding it to my portfolio. And the next one is Target, which is currently sitting at just above $140 per share. And I'd like to see Target in a similar price range as Apple, but I would consider starting a position in it if it reached somewhere in the mid 130s or so. But anyway, those are all of the stocks that I'm currently looking at. And if you want to hear about a handful of other ones that I'm most definitely staying away from and suggest you do the same, check out this next video right over here. In this one, you'll learn about 3 pretty popular dividend stocks that many investors love to buy for their high yields and monthly dividends, but truth be told, they're not great investments and you should avoid them at all costs. So click right over here and I'll see you in the next one.